Tops and bottoms of markets are the most difficult time to be in a market. We get very conflicting views of what is happening around the lows, with most of the negative news coming out at the bottoms. And the same thing happens at the tops, with most of the positive news coming around at the tops, telling us why we need to remain in the market for longer. So as investors, how do we sort through this noise, and how do we find out whether the smart money is buying and whether we are going to get left behind in the next stage of the cycle? Let's have a look at how the smart money is disguising their purchasing of stocks in today's video, looking at many of these signals that are coming through on the breadth and also the moving averages. We're also going to take a look at what is happening with the market psychology along with the market sentiment. So don't go anywhere. Smash up the like button if you like the change of t-shirt here, going from a green to a white. If you don't, let me know and drop a comment down below. While you're there, top of the video description is our free crypto and economic report. It's coming out this week, so subscribe to that. You'll get that sent to your email inbox. And finally here, the last of the shills, Bybit, BitGet, thousands of dollars of sign-up bonuses during this transitional period. Use those links down below, as we have trading strategies designed solely for users of these particular links. And many of our students are using that to be making profits in their crypto trading right now. So let's dive into today's video. We're going to look at Bitcoin with some of the news out here. We're going to look at the news that's coming out from the Fed this week, because all of this stuff is essentially a whole lot of noise that plays into the psychology of a market. And we need to remain as vigilant as possible and just look at the data that is coming through, as this hopefully gives us some signals on how to start playing the market next. Of course, I have my bias in the market, how I'm playing the market as an investor. I've been in the markets for over 16 years now. I bought my first property in 2006 and started trading in 2010, and then in crypto in early 2017. So this is what I have experienced. I will give you my opinion at the end of the video, but I want to go through the data first up, looking at what can we expect this week in terms of volatility and the noise which the market will start to turn its attention towards. First up is Tuesday morning, Valentine's Day. Happy Valentine's to any of you guys that are celebrating. CPI data coming out Tuesday morning for the guys in the US, and obviously the evening for us over here in Australia. Wednesday, same sort of thing, more US data. Looking at this red little Forex factory signals here, this is the stuff that could be volatile for the market. Core retail sales month over month, and the signals or the outcomes that the market is expecting. We have the previous reading, the forecast, and the actual. And so we want to make sure that the market hits around those forecasts and nothing too crazy. Now, the final one here for Thursday, so Thursday morning and Thursday evening for us, is core PPI month over month. They're the things to be watching out for this week for the volatility. I'm not going to go into too much more with that, because at the end of the day, like we've seen many times before for the last couple of years, the Fed comes out, talks about something here, the market reacts short term, good trading opportunities, and then the cycle continues on like it always has done. So let's look at the data, the objective stuff here. Another great post here from Seth. If he's watching, let me know in the comments section. Now, this one here is looking at 50 EMA cycle. So this is the stocks that are going from -10 to greater than 85%. Essentially what this is reading is the percentage of stocks that are above their 50 exponential moving average cycle from below 10% to greater than 85%. So if there was less than 10% of stocks on the New York Stock Exchange, less than 10% that were going above their 50 EMAs, and now that's spun to over 85% of the stocks. So say 10 out of 100 were above their 50 EMAs, and now that there are 85 out of 100, this is typically a good signal that we're about to see the start of a bull market. Now, this only goes back 20 years, going to 2002, when we got the bottoms on the stock market. So 2002, looking at the data right here, and then in 2003, when they started to swing to more than 85% going above their 50 EMAs, that was the start of the bull market. We can see that it basically trended all the way through to 2007, Obviously, the market had a big crash from that point. 2009, there was the bottom. So less than 10% of stocks, nearly 0% of stocks were going above their 50 EMA. And then that swung the other way to going above 85%, which then led to that first start of the bull market. Had it again in 2011, into 2012, bull market. And then obviously we know the bull market continued on from that point. So many times in history, this has occurred and it was the start of the bull market. But remember, it has to go from the bottom to the top. You have to see those stocks go from almost no stocks hitting new highs or going above their moving averages to the vast majority of stocks. In this case, it's over 85% of stocks going above their moving average, which is then the signal that potentially we've bottomed. In this case, it says it's bottomed every time, but within the next 6 to 12 months, we've had a positive rate. This is just reading the data, and we've just seen it happen here from the low that we got in 2022 to the top we've just seen recently in the early part of 2023. So we've just hit that same sort of signal there. We could see it earlier on here in the middle of 2022 to that first peak. That was probably August. And if we look at the chart, that's going back to this one right here. So this is one of those signals that didn't essentially play out, but like I've looked at many times before, this to me has been the transitional period that we've experienced since probably around that May bottom, more likely the June bottom. So the market transitioning from extreme bears to the flip and potentially going into a new bull market. So that was one of those times there where the market didn't flip into a new bull market straight away, but note where the next bottom came in, only barely lower than the June bottom. And since that point, we've bounced away from that as well. If it's wrong, this data is wrong here, and the probabilities end up being a smaller possibility that we don't go higher, maybe we see the market drop into a higher low, which then stalls this reading for a little longer before we start to get that reading again. If you've been following me on Twitter, you know that I'll be posting about the UK stock market. I know most of us are interested in the US or Australia or crypto, but this is important to look at the stock markets which are hitting new all-time highs. So we often see it in this data where stocks are hitting new all-time highs, or at least in this case, new 50 EMA highs. But what we're seeing here is the entire stock market of the UK hitting new highs. Sure, we've had a correction over the last couple of days. 2 days of last week, it hit a new all-time high. This is not the sort of stuff that we expect to see in the biggest bull traps of all time, in bear markets. This is just the data that's coming out. It's hitting new prices. And basically, the thought of the market going to a new all-time high at any of these major bottoms in 2022 was almost impossible. Could you imagine thinking that the stock market was going to go to a new all-time high within about 12 months from the Russia invading Ukraine or from this October low? Could you imagine that it was going to go to a new all-time high in those few months? Not many people did. This is what has actually happened, not just my opinion. This one is looking at the industry breadth. So this is basically stocks that have gone from their under their 200-day average to above their 200-day average. So percentage of stocks that are doing this. Now I'm going to move my head out of the way, and we're just looking at the occasions that this has happened basically over the last 7 years. You can see they have to go from their lows to hitting this reading here at around 90. So a percentage being 90. That is number of stocks in the S&P that were hitting 200-day averages, and there was less than 10%. It ran to over 90% or touched thereabouts 90%. And in that case, the market basically moved up from that point. So that's what this is trying to indicate, that when we go from a big move from the majority of stocks under their 200-day average to then flipping quite quickly, going above their 200-day average, you tend to get a bit more of this run on into a new high, or at least the bull market continuing on, where you're better to be on the long side than the short side. You can see again here in 2020, this was the pandemic low, market raced away, made the signal that the market was ready to go up. This was about September, October of 2020. And we know from that point that the market just took off into that peak of January of 2022. So we really needed to be in the market all of 2021. But remember, at this time, people were still calling for the market to collapse because of how fresh the pandemic was in everyone's mind. And if you remember back to this period, this was like the second outbreak, and then the third outbreak, and then the fourth outbreak. And it was just outbreak after outbreak, and we're going to lock down again and lock down again. And basically, the market didn't care. It just kept going up from that point. So it's important to just read the data that's on the charts, check out the signals that the data is giving us, and play the probabilities on our side. It doesn't have to happen 100% of the time, but when we look at the data long enough, we can see that the probabilities tend to play out in our favor if we are just willing to read those signals. You can see it went under, and now, just now in the last week, we are just nearly hitting that 90 on this reading here. So this is the level that we are waiting for the market to hit for the signal. So that's a good time to bring up the Wall Street cheat sheet, the psychology of a market. We know from history how crazy markets can get to the upside. But if you weren't around in 2019 or 2020, say for the crypto or Bitcoin markets, you would have missed out on the feelings through the beginning of that market, the old depression, then into the disbelief, maybe even into the hope. And this is all masked as the possibility of it just being complacency, with any sort of drop down being called anxiety, denial, panic, even though the market is climbing higher with higher lows. So right now, we could just be in this sort of area around this depression. I know many are calling for it to be around anger, where we're just about to bounce and then fall back into a low. But overall, if we're using this as any sort of guide, the pricing is probably around where we need it to be for a low, and the timing, although it might not be exact, is probably around that timing as well for us to be going through some sort of accumulation. The disbelief stage is typically where the majority of the bears who are waiting for all of these type of events to occur get absolutely wrecked, because they're still waiting for this market to creep lower and lower and get back to the prices of where it was previously. Now, of course, this is mainly subjective. Like, there's not really a way to identify this to a T, but the best way we've found is using the crypto fear and greed index. Now, I've noted before that 60 has been a pretty reasonable level of resistance for the market. That's exactly what we're seeing again. I don't mean to be on the old exactly as we expected, but when you're looking at a chart and just looking at the support and resistance, it's pretty hard not to see where some of these support and resistance lines are. I understand if you're starting out, it can be a little bit tricky, so just pay attention to what the data has done previously and start to get aware of where these angles and support and resistance lines are coming in. Take a look at how the higher lows are forming, like we were anticipating during this low. We can see the June low, and then the November low was getting higher in the sentiment of the market, what people were feeling and experiencing. Even though FTX took out a lot of people at that time, it was showing that the downside was probably over, because people were still looking to buy in the markets, and they were becoming less fearful and starting to creep back up into that sort of neutral feel about the market. Like we've seen now, we've hit greed last week, and we've just slipped back into neutral as the market takes a few days off from those peaks at around 60. Just like we chart Bitcoin, crypto, stock markets, anything with a chart, we do the same thing using the crypto fear and greed index. Looks like a double top. If this market doesn't come all the way back down into an extreme fear, then we could expect that their higher low is formed, and a breakout of those levels would then induce even more greed into the market, like we saw back in 2019. You can see there's a bit of congestion around here, again, that mid 50s to 60s. And in this case, we did hit the 70s a few times. Going into that peak that happened in June, right there, you can see that the market did have quite some volatility within the feelings before we finally hit that top. And then the market had to reset itself, come back and test those extreme fear levels again before we go into that major bull market. So there's still a fair bit more time here, but just to note in the short term compared to the long term, that maybe we do see some more downside in the emotions, but look at where this low comes in. Are we going to get a higher low form here? Or can the market break through this level? That would mean that we'd get lower prices for Bitcoin and cryptos. Now, that narrative can come from anywhere. And at the moment, we got a narrative for BTC around the SEC regulations and the death cross on the weekly chart here. And so when we do get these crosses, which are typically supposed to be bearish for the market, they're so laggy that it probably doesn't even matter in the long haul here. Not that we've ever seen one on Bitcoin before, but when this signal is used, death crosses and golden crosses, they're so laggy that it's probably towards the end of the move anyway. So I don't think there's anything to be worried about. That's my opinion of BTC, provided we remain above significant levels here, around 18,500 on any of these pullbacks. We're still in a pretty good position to continue on 2023, aiming to put in higher lows and creep our way higher into that next stage of the bull market, leading into the Bitcoin halving in 2024. And of course, we'll probably see some altcoins pop off with some mini altcoin seasons here and there. So make sure you do stay tuned to the channel, subscribe, like, follow us down below here. Crypto economic report coming out this week. And of course, our channel sponsors Bybit and BitGet, thousands of dollars sign up bonuses. And if you're only trading spot, you're not going to get wrecked. You can chill out. You've also got 0% fees on spot trading for a limited time. So use those links down below. Stay safe out there. I'll see you guys at the next video for another summary of the markets, back testing some of the macro signals and indicators out there. Otherwise, I'll see you back here tomorrow for the next video. Until then, peace out.